Hi, this is John at LTCi Plans. If you take just a few minutes, I promise you we're going to provide personally relevant financial planning information with supporting evidences that you've probably never heard before. We're going to show you how you can manage your extended healthcare risk, and we're going to give you personal access directly with me for personal consults for you and your family members. So let's jump right in. First, let's talk about what long-term care actually is. It is anything that is not recovery care. As long as you're showing signs of progress, doctors and hospitals are going to provide the care and your health insurance is going to pay for the care. But if your care is deemed chronic, custodial, maintenance care, that's all long-term care, and at that point you and your family are responsible for paying for providing that care. Nations around the world have created long-term care insurance plans for their citizens, and we want to talk about what those solutions are. We're going to talk about the stakeholders in this conversation, the payers of last resort, and the providers who provide that care and what they're encouraging you to do. We're going to show you different options you have to fund your extended health care need. According to the Department of Health and Human Services, 70% of us who live to retirement will have a long-term care need. 40% of those receiving care today are under the age of 65, working-aged adults who've had an accident, illness, injury, stroke, heart attack, and they need long-term care. It's about $90,000 a year for an average of 3.5 years, and there is no other program that pays for your long-term care. Nations around the world have been planning for long-term care for the better part of 30 years now. Let's take a look at some of them. In Germany, since 1995, there is a compulsory long-term care insurance program for all their residents. It's not an option, it's something you pay into, you have to do. About 2.5% of your income goes to the mandatory long-term care insurance program. In Japan, a law was passed in 1997 and enforced in 2000. If you're over 40, you have to have long-term care insurance in place. In Singapore, in 2018, they mandated that if you're between 30 and 40, you have to have long-term care insurance in place by 2020. And in China, a company called China Oceanwide Holding is purchasing the largest seller of long-term care insurance in the world, Genworth, to create a long-term care insurance industry for their 225 million boomers. So if it's this big of a deal in other nations, why hasn't our government told us we need to plan for this? Well, they have. When our government wants you to make a good financial planning decision, typically it's with tax incentives like a 401k, IRA, SEP plan, or to purchase a home, making the interest on your mortgage tax deductible, or planning for education. Well, they've done the same with long-term care over the last 30 years. In '93, with the estate recovery mandate, the federal government told state governments, at a minimum, states must recover assets that pass through probate, and at a maximum, states can recover any assets of the deceased recipient. From Medicaid, if you spend down all of your assets and qualify for Medicaid, the state is mandated to go after your assets. Now, HIPAA of '96 made long-term care insurance policies tax qualified. In 2000, the Long-Term Care Security Act created the Federal Long-Term Care Insurance Program for federal employees, and the Deficit Reduction Act of 2005 created partnership programs that encourage you to plan for this by protecting your assets. In 2006, the Pension Protection Act created new tax qualifications for life insurance or annuity contracts. The Class Act was a federally mandated long-term care insurance program that required you to purchase long-term care through your employer. Now, a lot of things in ACA were taken out and added to. This is very political. This was one of the things that was taken away because, quite frankly, I believe there was no way for them to be able to pay for a government-sponsored long-term care insurance program. I want you to look at the filial support statutes passed in 29 states and Puerto Rico, started in Pennsylvania. And the story goes that there was a mom who needed long-term care. She went into a facility, she got better, and she went back to her homeland of Greece. Well, she didn't pay her bill. It was several $10,000. So they went to her son and said, look, you owe us this money for your mom's care. Before they went to Medicaid, and the son said, I'm not going to pay it. They fought it out in the state courts, and the state ruled on behalf of the provider saying, yeah, the son does have a filial support responsibility for his mom. And that law has been passed in several states. The stakeholders in the conversation, obviously it's going to be you and your family and your assets. That's what we're trying to protect. But the other two stakeholders are the payers of last resort. After you've spent down all of your assets and qualified for Medicaid, a welfare means tested program, the payer of last resort is going to be the government. We're going to look at that, and we're going to look at what providers are saying, the other stakeholder in this conversation. So for us, the payer of last resort is called Medicaid. And like I said, you have to spend down to $2,500 personal net worth. There are income limitations, choice of care limitations. Of course, we saw the state recovery mandate, and certainly financial challenges for your family. We've seen what governments are encouraging their citizens to do, including ours, which is purchasing a long-term care insurance plan, having something in place so you don't have to go that route. But let's look at what the providers are saying, the other stakeholder. In the summer of 2018, the American Medical Association called for people to plan for their own long-term care, and let's take a look at specifically what they said. People should purchase long-term care insurance, maybe even as part of a portable long-term care insurance workplace program. But they went a step farther and said that it needs to be an automatic enrollment with opt-out provisions. Basically, the AMA said everybody should be made to have long-term care insurance. It's that important. And maybe you should look into a hybrid plan, one of the new life insurance or annuity-based long-term care insurance contracts. So the providers and the payers of last resort are telling you, please plan for yourself to protect you and your family. Now, you have several options available to you, including traditional long-term care insurance plans. They're the least expensive way to get tax-qualified long-term care coverage. Another way to fund your extended health care need is through hybrid long-term care insurance plans, life and annuity-based contracts. The benefits here are that rates are guaranteed never to increase. It does have cash value and a death benefit. If you never use it for long-term care, you pass that death benefit along to a beneficiary. Some plans have joint coverage, and there is an unlimited lifetime benefit on that plan. It is also tax qualified. Really, the difference is a rent-to-own concept. You just want to, with a traditional long-term care insurance plan, have the protection and security of that home, or do you want to own that home? Do you want to create equity in that home with the cash value and death benefit that comes along with an asset-based long-term care insurance plan in one of the new hybrid LTCi plans? If you click on this page, you can learn more about the 1035 exchange rules. This is where the government said, look, please make a long-term care insurance plan, and we're going to allow you to pay for that plan using assets that you already have, maybe in a whole life policy with cash value or an annuity. It's an excellent way to avoid having to pay that monthly premium or annual premium and go ahead and take care of this. Now here's a grid that we created that kind of shows you the balance between the premium you're paying and the benefits you're receiving. You can see short-term care plans cost the least amount, but you're getting the least in benefits. Traditional long-term care costs a little more, but you're getting more. I think asset-based long-term care insurance plans are a life-based LTCi plan. A true 7702B plan is the best balance between the premium you're paying and the benefit you're receiving, but that's a choice for everyone to make for themselves. Now, not designed to pay for your long-term care, Medicare, health insurance, disability, critical illness, they're all very important and they play a specific role, but they are not designed to pay for your long-term care. So what are your next steps? Well, now that you know that the payer of last resort and providers are begging you to make an LTCi plan, learn more by clicking on our information website. Contact us, reach out to us, and ask for a personal consult. We'd be happy to help with you. As a matter of fact, we're going to put a button on the screen right now where you can request a personal consult directly with me if you'd like. And talk to your family members. Speak with facility administrators. Contact your CPA or financial advisor. So now that you know what risks are involved with an extended health care need, make a plan. Put an action plan in place to protect your family, protect your assets, and protect the choices you have. And remember, an LTCi plan protects all the other plans that you've already made.